Okay, I wanted to do another valuation using the dividend discount model, or the dividend growth investing model, we could say. All right, so the formula we have is the value of stock J, or the price that we wish to pay in order to get our required return, is equal to the current dividend, the dividend in period 1, divided by our required rate of return K, minus the sustainable growth rate over time, maybe the average growth rate or the growth rate we expect over a 10 or 20 year period. So the stock for which I would like to do a valuation is going to be Bankia, a Spanish bank. We're going to just value it, I understand that there are other issues concerning the banks right now, but I'm going to value it just for this exercise purely based on the dividend growth model, and I'm not going to take into account any other exceptional factors, such as political risk being one of them. Alright, so Bankia, what are the inputs? So the value, so I'm going to put Bankia in green, so the value of, instead of J, I'm going to put B for Bankia. The value of Bankia is going to be equal to the dividend. The current dividend is a little bit low right now, so I'm going to change my dividend input. The current dividend is about 2.5 cents per share, and the current price, alright, I'm going to put it here. So the dividend is currently 2.5 cents, and the current price is around let me think about that. It's around 70 cents. However, oh sorry, that's not percent, that's cents. However, the thing is here, the earnings per share are around 10 cents, so the current dividend payout is really low. So what I want to do, considering this is an infinite model, is I don't want to use an unusually low payout, so I'm going to have to adjust that. I want to put a sustainable payout of 50%. So I want to put a 50% payout. So I'm going to adjust this figure up from 2.5 cents. I'm going to have a starting value of 5 cents, which is what they could pay right now, and it should be the sustainable starting point. Right. So D1, going to have 5 cents, and my required rate of return, considering a number of risks involved in the stock, I'm going to ask for a rate of return of 10%, which is higher than the average historical return of the stock market as a whole. So I'm going to put a risk premium on Bankia over and above the rate of return needed to buy the general market. Less the growth rate. Well, I think there's quite a good chance that the growth rate is going to be basically zero in inflation adjusted terms, because the future of the banking industry is we're not looking like we're going to have much of an increase in debt levels from this point. So the banking industry as a whole is probably going to be a zero growth industry in Spain for some time, and there's no real reason for Bankia to increase their market share substantially either. So the growth rate, there's not a reason for them to lose it or gain it, and there's not a reason for perhaps the debt level to increase or decrease substantially. So I think we're looking at flat growth. However, inflation itself, we have a 2% inflation target, so I am going to input 2% with growth equal to inflation, which I estimate over time to reach and to stay at the 2% target. Alright, so going further, so V of B is going to be equal to our 5 cents divided by the adjusted required return, which is the required return less growth. So that's going to be divided by 8%. So 5 cents divided by 8% gives us a target price of 62.5 cents. Well, we can say 62 cents to round it. Alright, so given a 50% sustainable payout and zero growth, we would have a target price of 62 cents. However, looking at this, it's true that if you've got zero growth and very close to zero reinvestment requirement, what we can do then is say that it's not necessary to have such a low payout rate. So what we can do, because this looks exceptionally low, it would be if we divide that 62 divided by 10 cents, we've got a 6.2 price earnings ratio. So it's actually very, very cheap. So alright, we've calculated with the dividend discount model, but since it's in contradiction to another model, which is the price earnings ratio, I'm going to adjust my inputs. So given zero growth, I think we can increase the payout to 80%. So let's see what difference that makes with an 80% payout. So this time, instead of 5 cents, I'm going to input 80% of 10 cents is going to be 8 cents. So the value of Bankia is equal to 8 cents divided by, I'm going to use the same denominator as before, so I'm going to input 8%. And this should be immediately obvious that in fact I'm dividing 0.08 by itself. So that's going to be equal to 1. So this time, by changing my inputs, I've increased the value to €1 per share, which seems more realistic. And in fact, if we increase to 100% payout, and so we get to 10 cents per share, then the value of Bankia will be 10 cents discounted by an 8% required return will be equal to €1.25. And the other way we could increase our target price would be if we reduced our required return here to a more normalized figure. So if we input, instead of 10%, if we input a normal, so if the political risk and other risks are resolved and Bankia comes to have a normalized required return, then we would have the value of Bankia equal to 10 cents over, instead of 10 minus 2, I could input the historical stock market return and put Bankia's valuation and the risk premium in line with the rest of the stock market in general of 7.5%. So if I change this to 7.5%, then I've got 7.5% less 2% gives us 5.5% discount rate, and the new value is going to be 10% divided by 0.055, €1.81, which is actually an entirely possible valuation for Bankia. In fact, probably a quite likely future valuation once we get through the problems with the banking industry. Looking at five-year basis from now, probably could be a good target.